Hey guys, Joel Frank here, market analyst for YouTrading, and in today's video we're going to be taking a quick look at a couple of trade ideas that I am currently monitoring. The first one, as you can see, is to do with dollar yen, which just purely technically speaking looks to be at a bit of a crossroads. We've been consolidating here around 130 now for about a week. The 21-day moving average, that blue line just to the upside, that has been giving really good resistance. We've also got the trend line that's been in place since last November, downwards trend line, which is also giving resistance as well. But you can see since the middle of the month, we've been edging higher and the price has been getting squeezed, which just from a technical perspective generally means that a breakout either to the upside or the downside is likely. Now, we've got a lot of important macro events coming up this week. Let me just show you the calendar real quick and we'll whiz through it. ISM manufacturing PMI and JOLTS tomorrow before the Fed meeting, which is the most important event of the week. And then US jobs, official jobs report on Friday, and ISM services. So plenty of very, very important macro events to be keeping an eye on that could affect the dollar and by virtue dollar yen. A lot of people thinking that the Fed is, given the recent easing of financial conditions, i.e. the dollar falling, stocks rising, yields a little bit lower, the Fed might want to come across as hawkish to try and deter animal spirits from coming back into markets too strongly, like the rise in crypto as well is indicative of the return of animal spirits. So, if that is the case, that could potentially trigger an upside break. However, how much credibility does a hawkish sounding Fed actually have? Because yes, okay, they're going to hike another 25 basis points, taking interest rates to 4.5 to 4.75%, that range tomorrow. But then markets are only expecting one more 25 basis point rate hikes. Well, maybe the Fed indicates that they actually want to do one more beyond that to take interest rates above 5%. But the data doesn't seem to support them being that hawkish. We've had fresh evidence today, just now, employment cost index, quarter over quarter, 1% lower than expected. So wage growth is slowing more quickly than expected. We've had plenty of evidence that inflation is slowing more quickly than expected. This upcoming ISM and jobs data, like the ISM services and manufacturing PMIs, could show that growth is stagnating quicker than expected. If this jobs data is weak, it all points to a potential slowdown in the US economy, and a lot of people are expecting a recession later this year. So, yes, a hawkish Fed could trigger a jolt higher, but if it's not credible and markets don't believe it, it's not going to be the trigger, I don't think, of a lasting, like a recovery to the 200-day moving average in dollar yen. So, if there is an upside break, what I'll be doing is looking for places where you can start adding to short positions, basically. I mean, one of the first ones could potentially be this 131.40 resistance, support turned resistance area. Maybe that's a little bit too soon. Maybe we'd need to let it run a little bit higher, in which case I'd be potentially looking at this 134.60 area. Alternatively, though, maybe the Fed doesn't come across too hawkish and we just get a bearish break of this short-term uptrend, in which case you would be expecting a fairly swift test of the recent lows that we had around 127. Just quickly, another sort of all related at the moment, looking at stocks as well. S&P 500 is interesting me a lot at the moment because it looks like it's, technically speaking, at a very, very important point that could mean the end of the bear market. So, you had this downtrend that lasted pretty much all of 2022, with the 200-day moving average joining in and offering really strong support for most of the year as well. But we've had this crawl above this downtrend and this crawl above the 200-day moving average, and we appear to be in a short-term uptrend, as I've outlined here. Now, a hawkish Fed could spoil the party, of course, and trigger a break of this short-term uptrend, a fall back down into this or below this downtrend, back towards the 200-day moving average, the 50-day moving average, which would be bearish. If we broke below all of them, you'd potentially be looking at a retest of these levels And the Fed isn't the only important thing this week for stocks. Obviously, there's all the other data that I just mentioned, but there's also big tech earnings from the likes of, well, Meta Platforms, formerly Facebook, Amazon, Alphabet, Apple. Some of the biggest names in, that those companies make up a stonking percentage of the S&P 500, like maybe 20%, something ridiculous. So if that goes badly, then, we could be looking at this rally unraveling fairly swiftly in early February. Equally, though, a Fed that's not too hawkish, data that supports the idea of the US slowing down and the Fed not needing to be so aggressive, and better data means that we could probably continue this crawl higher. It really is a 50-50, though. To be honest, I just have to wait and see what happens. You have to be nimble. But if macro headwinds go well this week, we could be looking at a test of the December highs in the 131 area. So yeah, that's what I'm looking at the moment, guys. Hope you all enjoyed the video, and I will see you all in the next one.